Bitcoin, one of the primary things you should be looking to cash out, so to speak, into would be gold and precious metals, because once again, you look at the 100-year chart for the dollar, or any local currency for that matter, because that's the cool part about both of those assets, is that they're global. It's not just the United States. We talk about, Bitcoin or gold's price in US dollars because the US dollar is the world reserve currency, and most other people do too. But if you go to any other country, they're going to denominate that in their local currency, whatever that is. And both gold and Bitcoin have hit new highs in multiple other countries this year just for that same reason.
Okay, so when you take profits in Bitcoin, you put it in gold. Did I have that right?
I've been looking at doing that, yes. I'm also interested in cryptographic gold, but that's a discussion you've got kind of at the end.
So if you're taking your profits in Bitcoin and putting it into gold, what does that imply about your money? Is your money Bitcoin or is your money gold?
To me, they're both money. Like they've got different properties, and the market, as you well know, right now. So the concept of commodity money, right? Like no one had to say gold was money. Aristotle just noticed that gold had become money because the wealthiest people were using it. And that's the concept of commodity money. The market chose it as money. I didn't really technically choose it as money, even though I use it that way. The market is what's doing the choosing. So when you look at it from that perspective, it's more about, well, if the market cycles up and down, if you're looking at those cycles, and no doubt Bitcoin's way more volatile in price than gold. So if you hit a market top in Bitcoin, that volatility is going to have it way more overvalued based on what the fair value is, because the market's always going to be overvalued or undervalued, but it's always going to trend towards what the fair value is. So when you look at it from that, if it gets too far overvalued, you probably do want to take that profit into something. Now, that doesn't necessarily mean that if you're not someone that's going to follow the markets and follow market cycles and do that, you're better off just, whether it's gold or whether it's Bitcoin, just sticking it away and forgetting about it. But at the same time, you can always use that fact that we're dealing with this system that's inherently volatile in and of itself with the dollar, that when those overvalued or undervalued periods come up, I would kind of more compare that to the way, I know at various points in your time, you used to go back and forth on the ratio between gold and silver. And when gold would get overvalued relative to silver, trade one for the other. That's kind of how I would see that Bitcoin and gold relationship in much the same way.
I'd say that's a great analogy, and I think I understand it. Although I think the volatility in Bitcoin would set my hair on fire.
Well, I mean, actually, it's been getting less volatile. Like that's the interesting part about it. So, like, an $800 move in Bitcoin, in 2016, was a ginormous move relative to its value, and now an 800, like percentage wise, it's gotten way less valuable. I know I'm kind of jumping the shark and going to one of our other questions that we had there. But when you look at that, the biggest drops it's had, in 2011, it was a 94% drop. In 2013, it was an 87% drop. And the one that happened most recently, the 2017 drop, was an 84% drop. And those numbers sound kind of similar. But if you actually think about them long enough, if Bitcoin's valued, drops by 85% and drops down to $3,000, if it were to drop another 5%, you're down to $2,000. And if it was down to drop another 5% of that, you're down to $1,000. And that's the way that's why we use percentages, because they paint that picture clearer. But when you're talking about how much that fluctuation has been, it's throughout its entire history, it's been getting less and less volatile. That's not to say that, the drops won't make your stomach churn, but they've been getting less stomach churning, but that also means that the amount it overperforms relative to the market is going to go down too along with that. So it's like, no one got rich from $100 investment during that last market cycle. If you bought $100 worth of Bitcoin and it went up to, at $1,000 and it went up to $20,000, you had, $2,000 all of a sudden after your $100. Whereas if you did that at the very beginning on those market cycles, there were people that just made out completely rich from just that same $100 purchase.
Mm-hmm. Yeah, I don't know. Personally, I find the kind of drops that we're talking about pretty stomach churning. I mean, the 94% drop for sure, but I'd argue that an 84% drop is pretty bad also from the standpoint of a store of wealth. I mean, we in our communities, we complain that over the past 100 years, the value of the dollar has dropped by 90%, 95%, but Bitcoin seems to be able to do that in weeks.
Well, it's more like months now, but here's the thing is every time it's dropped like that, it's made a higher low on the price chart, which shows a march towards fair value that hasn't been discovered yet. Mm-hmm. So yes, it's definitely more risky in that sense. But the other part to remember about this is a lot of these people that are starting to get into it, like the big investment firms, their rationale is that they're not buying, enough that it's 20% of their portfolio. They're buying like 1% of it in their portfolio and just sticking it away for a long time because they know if they lose that, if that 1% goes down to 90%, it didn't affect their portfolio value. Mm-hmm. But if it does a 20x, 10x, all of a sudden, they added 10% of value to their portfolio. Mm-hmm. So you're right in the sense that it doesn't have enough behind it to be, even for me to call it like a true store of value. But in terms of like a speculative store of value, something that's growing into like a full-blown store of value, I think that's what we're on the path towards. And that risk return, the risk of reward ratio is what entices people in, but it's also what makes people afraid to get into it too, because I can completely understand why someone who's already set, would much rather have gold. That's usually what I'm telling Bitcoiners is, don't make fun of gold because, it's the store of value that is the safest. You're talking about the one when you compare the two, to me, it's like comparing the store of value that's got the most volatility that I can think of to the store of value that's got the least volatility I can think of.
Right. That's fair enough. Okay. Another subscriber wanted us to discuss Bitcoin's hardness as a money compared to gold and talk about why this should give Bitcoin an advantage as money.
I agree with him 100%. I think that's one of the biggest things that most people don't understand about that difference between something being scarce versus something being fixed. Bitcoin is mathematically fixed, the amount that comes into the market every 10 minutes with each block. Whereas gold can fluctuate, like 2,500 to 3,000 tons mined annually. You don't know where you fall within that, and you can't audit it. Whereas anyone can just download Bitcoin software, download the blockchain, and run their own verification for exactly how much Bitcoin there is, exactly how much has been mined, and it's going to continue to get less throughout time. And that's something that gets me most excited about it, because it's something that's never existed in human history. We've never created something that we can't create more of exponentially. It's really amazing in that sense. The invention of digital scarcity and being able to say, we created this, and you can't create more of it. And I know that'll probably lead into the conversation about altcoins, but
Well, we'll get there. We'll get there. But, I'd look at the flip side of that coin, and I'd say, that could also be a liability because, I take a look at history, and one thing that I've concluded is that I know that the gold standards that we've had in the past failed because of gold's hardness. Now, I mean, it's a good thing to have, a money supply where it can't be inflated, right? But it's not a good thing to have a money supply that's completely inelastic, because in order to have a credit system, you have to have money that's actually obtainable. And one of the big problems that was created in the 19th century, back in 1873, was when the United States came off of the bimetallic standard. And the reason why that was a big problem was because the big banking interests basically controlled most of the supply of gold. And so by demonetizing silver, it took the means of paying down debt out of the hands of farmers and small merchants who basically had these debts and were able to pay in money that they were able to get their hands on. And it redefined things so that they would have to pay it back in money that was really, really difficult to get their hands on. And the reason why this was a problem was because how should I say this? The stability of debt basically relies upon two things. One, the willingness of the borrower to pay back and honor claims, but also the ability of the borrower to pay off claims. And so if you have a money that's too hard, that means that any debt system that's based upon it is going to fail. Right. And so, we eventually even abandoned the gold standard because we found that, it led to problems. When trust was lost, everybody made a run on gold, first on the banking system back in the early 1930s, and then eventually internationally, countries made a run on the treasury gold. And so we just had to get rid of it to the point where now no debt is denominated in gold. Yeah.
Couldn't we also see that as not necessarily a problem with using hard money, but a problem with having centralized parties and their liabilities that get out of hand? Because that's kind of how I see it, is you've got these, you've got this system where if you're allowed to create that money and to lever yourself to create that because it's debt, we keep getting out of hand with that, and that hard money is what brings that back into balance.
No, I don't think that that's the major problem. I mean, it is a major problem, but I don't think that that's the major problem. Let's take a look at the 20th century. That was a period of greatly expanding economic activity. And the main reason why economic activity was able to grow the way that it did was as a result of the Industrial Revolution, as well as the use of fossil fuels. So we were able to make the future much, much greater than the present simply from productivity improvements. And in order to unlock those productivity improvements, it required loans. I mean, when people invest for the future, they need capital, right? And ordinarily that means that it comes out of borrowing instead of, people's savings. And so, if you have credit that's built up and you need to pay that back from the future, one thing that I know happens is that if the money supply is inelastic, productivity improvements generally lead to a decline in prices. Can we both agree upon that?
Yeah. Oh, yeah. That definitely.
Right. When you have a decline in prices, what it means is that revenues are going to be harder and harder to come by, at least revenues proportional to the loans that you took out. And so what I think is necessary is to have a money system that is actually able to expand to meet the rate of at least productivity improvements. Because otherwise,